Good morning once again. I am Lakshman Sharma from Delhi Public School, Ghaziabad, Meerut Road. Today, my dear students, we are studying about financial statements of class 11th. I am here to tell you something about financial statements, and I understand that you will understand the concept carefully. See, my dear students, financial statements are the statements which is prepared at the end of accounting year. Every year, every sole proprietorship firm, every partnership firm and every company needs to prepare the financial statements. It is prepared at the end of accounting year. I repeat, my dear students, at the end of accounting year. We already know about the things that accounting year can either be calendar year or financial year. Students, we have to prepare two financial statements actually. One is income statement. One is income statement and the second one is position statement. You can see on the board, the balance sheet is nothing but the position statement. Income statement includes trading account and profit and loss account. And balance sheet is also known as position statement and point statement. Together, income statement and position statement is known as financial statement. What we are studying here is the financial statement for sole proprietorship firm. And later on we will come to the part how the sole proprietorship firm prepares the other accounts. See, my dear students, financial statements includes income statement. It is prepared to ascertain the value of net profit or net loss. Either the firm has the profit or loss at the end of accounting year. That profit can be determined with the help of income statement. I previously told you, my dear students, income statement includes trading account and profit and loss account. Trading account is prepared to check the gross profit or gross loss. It records opening stock, purchases and direct expenses on the debit side. And it records sales revenue and closing stock at the credit side. If the credit side exceeds, the balancing figure will be gross profit. And if the debit side exceeds, the balancing figure will be gross loss, which will be later on transferred to profit and loss account. My dear students, profit and loss account is nothing but prepared after the trading account, and actually it is known as the main account. Profit and loss account records all the indirect expenses on the debit side and all the incomes on the credit side. If the credit side of profit and loss account exceeds, definitely it's a good thing for the company, it's a good thing for the sole proprietorship firm too, and it is giving the net profit. But on the other hand, if the debit side exceeds, it means all the expenditures and losses are more than profits, hence it gives the loss, net loss to the firm. See, my dear students, balance sheet is a very important topic indeed, and we must understand the balance sheet properly. Balance sheet is nothing but the financial position statement. It records all the assets on right side and all the liabilities on the left side. Balance sheet is nothing but the summary of all assets and all liabilities, which includes capital in the liability side only. You better know, because the capital is the internal liability for the business. According to business entity concept, the capital is recorded in the liability side of the balance sheet. Students, understand the terms position statement. Why? Because balance sheet indicates the financial position of the business at the end of accounting year. Hence, it is called the position statement of the firm. Similarly, it is also known as point statement. Point statement because it is prepared as at 31st March or 31st December 2000 -- because it is indicating a financial position at a point of time. Hence, it is known as a point statement. Hope you understood this carefully. See, my dear students, every business organization prepares the financial statement for sure at the end of accounting year. And there are various users of these financial statements. The users may be either internal or external. You better know the internal users are number 1, management, number 2, owner, and number 3, employees. Rest and remaining all the users are external users. Either they are investors or potential investors, or the banks or financial institutions, researchers, government, tax authorities, whoever it is. The 3 internal users are management, workers, and the owner. Right? Lots of users are here. Tax authorities, employees, lenders, suppliers, management, investors, potential investors, consumers, etc. You must go one by one for all the users how they are going to get benefit from our financial statements. This is your homework, my dear students. Please understand carefully. Each and every user is going to use the information of financial statement, and they are either going to get benefit from it or they are going to use it for the research purpose. Hence, the financial statements can be used for the betterment of number of other users also. See, my dear students, there are lots of things in financial statements. Like, we can classify the expenditure on the basis of capital expenditure and revenue expenditure. You can see the board. Money spent for acquiring the fixed asset is nothing but capital expenditure, whereas the money spent for maintenance of those assets is the revenue expenditure. If I am purchasing a AC, that is my capital expenditure. But if I am doing the maintenance of that AC, that is my revenue expenditure. Purchase of car is the capital expenditure. Amount paid for the fuel, amount paid for the maintenance, for the services of that car is the revenue expenditure for the firm. The benefits of the capital expenditures are definitely enjoyed for many years, whereas the revenue expenditures are incurred for a short duration and the benefit can be enjoyed in current year only. I hope you people are understanding the difference between capital expenditure and revenue expenditure. The main very important point of difference is where they are shown. When we were talking about the financial statement, income statement and balance sheet, the balance sheet is indicating the capital expenditures. Whatever assets are purchased, they are indicated in balance sheet, and that is nothing but the capital expenditures. Whereas all the income expenses which are indicated under trading account and profit and loss account, that is income statement, they are nothing but the revenue expenditures. See, my dear students, the capital expenditures are incurred to increase the earning capacity of business, whereas the revenue expenditures are incurred not only for generating the revenue but also for the maintenance of the assets. See, my dear students, the capital expenditures are real account by nature. Actually, personal, real, nominal is now outdated. We used to adopt the modern approach, but still I would like to say the revenue expenditures are nominal account by nature. It is our traditional approach, so we cannot miss it right now also. And you must do the difference between capital expenditure and revenue expenditure in real businesses. Choose a real firm and try to understand what kind of capital expenditures they people are doing and how many and how much revenue expenditures are incurred by them, and you will understand the net profit can be generated after deducting the revenue expenditures. But the capital expenditures are there with the organization for a long duration of time, and it is there for the longer accounting periods. I hope the difference between capital expenditure and revenue expenditure is understood by you. Now, a word which is very important for you all, that is deferred revenue expenditure. See, my dear students, the word says deferred revenue expenditure. Those expenditures which are incurred for the current year, but the benefit will be enjoyed in the near future also. See, there are lots of differences, lots of expenditures which are huge, like huge advertisement expenditure. The huge advertisement expenditure will indicate that the amount of expenditure can be enjoyed in future also. Hence, a part of expenditure can be used for current year and remaining can be transferred to the balance sheet as capital expenditure. Thank you very much.